If you like the idea of making cash flow without working for the cash flow, you'll love investing in dividends. And in this video, I'm going to show you how you can live the dividend lifestyle, meaning use your dividend income to pay your life's expenses. There are 7 general ways that you can generate this passive cash flow. They are, number 1, putting your money into a high yield savings account. So if you have extra cash, you throw it into a high yield savings account paying 2, 3, 4, maybe 5% a year in interest that you're getting for doing nothing except keeping your money in that savings account. The only problem is the value of your money is not growing. So even though you're getting some interest, it's not really beating inflation. And if it is, it might not be by that much. Number 2 is by lending your money out. If your broke cousin Bunty wants to go out and buy some Gucci, you can lend him the money to buy that Gucci wardrobe, but then you have to hope that he pays you back. So yes, you can generate some interest, but there's of course risk with lending money if you don't know how to qualify who you are lending your money to. Number 3 is royalty income. If you write a book and now it's on bookshelves and it's paying you money every month, that is a type of royalty income. Number 4 is rental income. Yes, this can be passive. In the beginning, it is not, but if you start buying rental properties and you can find a good property manager who is handling all the day-to-day work, well, now your tenants will be paying you rent. That rent should pay all of your expenses and put some money in your pocket. But it costs more money to get started as a real estate investor. It takes more headache to get started, and you got to know the right people. Number 5 is profit share. This is where you can invest into a large enough business, kind of like Shark Tank, and now you own a piece of the profits. So if a business that you own is making $1 million a year of profits and you are entitled to 2% of those profits, well then they will be sending you a $20,000 check every single year because you own a piece of the business that is making those profits. Number 5 is what I call BIRF. Be born in a rich family. If you're born in a rich family, well now you can just ask your parents to give you some free money. Not probable for most of us. And then number 7 are dividends. Dividend investing is now where you invest in a company that has extra cash. You can start with as little as $100, and now this company, this stock, will pay you generally every quarter, meaning every 3 months, a check, or generally deposit this money into your brokerage for doing nothing except owning the company. You don't have to go and work at the company. You don't have to worry about managing the company. You just own the right company, and then they send you a payment every quarter, meaning every 3 months, for doing nothing except owning the dividend-paying stock. I'm a cash flow investor, and one of the nice things about dividend investing is that this can be truly passive because once you find the right stock or fund, it can pay you essentially for life, assuming you made a good investment. And that's what I'm going to focus on today. Let's assume that you want $50,000 a year in dividend cash flow income passively. That's $4,167 hitting your bank account every month that you can use to pay your bills, to go on vacation, and buy you some nice extra guac. So how do you go about actually doing this? Starting with the basics, you need to have some extra money that you can put aside to invest, because the whole idea behind dividend investing is you're investing money, and that means you have to have money that's extra that you are not spending already. So you take your extra money and then you're going to put this money into your investments. I'm going to show you how to do that in just a minute. A simple rule of thumb that you can start with is something like a 75-15-10 plan, which says for every dollar that you earn from here on out, 75 cents is the maximum that you can spend. 15 cents is the minimum that you're investing. 10 cents is the minimum that you're saving. This way you always have money to save and invest, and so you don't spend all of your money. And now you take this money that you're putting aside for your investments into a fund or a stock that's paying you with cash flow every 3 months. That way you can work to achieve this dividend lifestyle. Now at this point you might be wondering, why would a company pay out this dividend in the first place? I'll just give you an example. In 2024, McDonald's had about $14 billion of profit. This was extra money in their bank account after paying for all their expenses, paying for all their employees, paying for all their burgers. Now, when they have this extra $14 billion in their bank account, there's 3 things that they can do with this money. They can save some of this money for an emergency, which they did. They can reinvest some of this money back into the company to create new burgers, to create new food, to create new whatever, and they did. And then they can just give away some of the money, which they also did. In 2024, McDonald's allocated a little bit more than $5 billion in dividends. That means they took a little bit more than $5 billion and just gave it away to their owners. who are their owners? It's the investors who own a piece of McDonald's. So anybody who owned a share of McDonald's got a piece of this dividend payout. This is money that you get for doing nothing except owning a stock that's paying out this dividend. The nice thing about dividend investing, unlike real estate, is you don't need a ton of money to start. I mean, you can start investing in dividends with as little as $100. And if you do it correctly, the goal is to hopefully see the value of your shares go up and also see an increase in the dividends that you get paid out year after year after year. So how do you actually achieve the dividend lifestyle? Well, you can invest in individual stocks that pay out dividends, which I'm going to show you, or you can invest in funds, which is like a basket of dividend paying companies, which I'm going to show you as well. Let me start by talking about some individual companies, but first, I'm not a financial advisor. I'm just a random guy on YouTube. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Everything that I'm talking about is for example purposes only to get you to start thinking like an investor. I'm not here to tell you what to invest in. Right now, at the time of me recording this video, McDonald's is paying out a dividend of 2.3%. AT&T is paying out a dividend of 4%, Verizon is paying out a dividend of 6%, Pfizer is paying out a dividend of 6.5%, and Google is paying out a dividend of 0.5%, which means if you were to invest your money into any of these stocks today, and your goal is to get this $50,000 a year in cash flow from dividends passively, well, you're gonna have to invest a lot of money today to achieve these goals. Let me show you what that means, and then I'm gonna show you how you can make it happen sooner than you might think. You would have to invest $2.2 million into the McDonald's stock today at today's dividend yield to start generating $50,000 a year today. AT&T is paying out a bigger dividend, so you'd have to invest $1.2 million. Verizon's paying out an even bigger dividend yield, so you'd have to invest $835,000. Pfizer's paying out an even bigger dividend yield, so you'd have to invest $770,000. And Google is paying out a much smaller dividend, 0.5%, so you'd have to invest $10 million to be able to see that $50,000 a year. Now, the reason why I'm showing you this is to make a point. Not every company is going to pay out a dividend, and you have to remember why companies pay out dividends in the first place. Because companies pay out this dividend when they have extra cash that they don't know what to do with it. And when they have that extra cash, they can just give it away. So when a company is focused on growth and scale and really trying to achieve as much market share as possible, they don't want to pay out dividends because that means that's money that they can't use to reinvest back in their company. That's money that they can't use to hire more employees. That's money that they can't use to invest in research. So when companies are focused on the hypergrowth and the scale, they don't want to pay dividends. For example, Amazon was a publicly traded company for years that was not profitable. Their goal was not to make big profits so they could pay out big dividends. Their goal for many, many, many years was to invest all their money and then some with the help of debt and venture capital and other investors' money. That way they could grow as big as possible, as fast as possible, because they wanted to see their share price explode, which is what we saw happen. Sometimes it works out, sometimes it doesn't. When we talk about investing for dividends, it's a different analysis. Now, what you're looking for is not that explosion in stock price. You're looking for steady profits that companies can keep paying out and hopefully keep increasing, because that's how you get paid your dividend. Now, the reason why so many people fail at dividend investing is because they look at these numbers and they get overwhelmed. You say, oh my God, I need so much money to be able to live this dividend lifestyle. It's going to be impossible. What's the point of me even starting, because I don't have hundreds of thousands or millions of dollars. It's too much work. And that's the wrong way to look at this, because the way you want to look at this isn't that you need to invest all this money today. You're building a machine. You're building out a machine that prints your money every 3 months. That's what dividend investing is. And you don't have to start with a ton of money today. The way you start is by putting a little bit of money in today. And then you put a little bit more money in tomorrow and the day after that. And every time you put some more money in, it spits out more money to you. And every time you get this money spit out, you take that money that you're getting and reinvest it. So you just keep putting more money in. When you get a pay raise, you put more money in. When you can save some extra money, you put some more money in. And every time you invest $1, you're buying a little bit of this machine that keeps printing you more money. And every time you get some more money, you keep reinvesting it. This is a long-term game, and if you stick with it, the results can be kind of crazy. You can start with a little bit and keep adding to it slowly. The second thing you need to understand is the risk. You can look at all of your options here and say, you know what, I want to invest for cash flow, so I'm going to invest all my money into Pfizer. But the problem with that is if you don't keep up with the company and now you have all of your money here, if Pfizer were to go bankrupt, not only do you lose all of your dividend income, but you also lose all the money that you invested. This is why it's so important to understand risk, because there are ways to mitigate this risk as well, which I'm about to show you. By the way, if you're interested in stuff like this, I created a free newsletter called Market Briefs, where every day my team at Briefs Media publishes a free newsletter that's breaking down what's happening in things like the economy and the stock market and the housing market, the crypto market, and the global economy into a fun, witty, and free newsletter. It's read by hundreds of thousands of investors every single day, and it's completely free. So if you haven't joined Market Briefs yet, I have the link for you to join down in the description below. The way you can lower some of your risk is obviously by doing your research, keeping up with the company and reading the financial statements and listening to the earnings calls, or number two, investing into funds. A fund is a basket of stocks. So you're investing into a group of dividend paying companies as opposed to just one, because if you invest in one of these companies and the company you invested in goes bankrupt, you lose everything. You lose your dividend income and you lose the money that you invested. But if you invest your money into a fund which has dozens or hundreds or thousands of companies and one of the stocks goes bankrupt, well, you're okay because it's balanced out by some of the winners. So it requires less work and less upkeep because now you're just investing in a fund, and this fund is essentially self-managing. It's managing itself, so you don't have to worry about it. I'm gonna go over a few examples. Again, I'm not telling you what to invest in. These are just examples. One example is SCHD, which is currently paying out a yield of 3.5%. As a disclaimer, I'm personally invested in SCHD, and this is a fund created by Charles Schwab that invests in high dividend paying companies inside of the United States. So it has a broad basket of dividend companies in the US. The other is NOBL, Noble. This is an ETF, a fund that invests in dividend-paying S&P 500 companies. That means this only invests in dividend-paying companies that are a part of the S&P 500. The S&P 500 is a basket of the 500 largest companies in the stock market. This only looks at those companies, but then it takes it one layer deeper. It only invests in the companies that have increased their dividend every year for at least the last 25 years. So if a company is in the S&P 500 and they've only increased their dividend for the last 5 years, they're not going to be a part of this ETF. So you can see it's pretty strict. And then the third is VYMI. This is a fund created by Vanguard, another large, very well-known institution that invests in high dividend paying companies internationally, not in the United States. And so when you're international, you have a little bit more risk, more potential return, where you're investing in companies that could potentially see upside because their country is growing, their economy is growing, and they could potentially pay out higher dividends. It's not for sure because it's higher risk, but that's where the opportunity is there. Again, this is something that I'm personally invested in as well. That's why the asterisk is there. SCHD, at the time we're recording this video, is paying out 3.5% a year. NOBL is paying out 2%, and VYMI is paying out 4.5%, which means if you wanted to achieve the $50,000 a year today, then you would have to invest $1.4 million into SCHD, $2.5 million into NOBL, and $1.1 million into VYMI. But again, that's not the game. The game is not to have $1 million or hundreds of thousands of dollars to start with today. It's to start small. Start with $100 today, and then $100 next week or next month, whatever you can. Small increments. Remember, every time you invest $1, you're buying a machine that prints out some money back at you. You get paid every 3 months, and you keep consistently investing your money. Every time you get paid, you invest some money. When you get paid more money, you invest more money, and then when you get those dividends, you keep reinvesting them. That way you keep building a larger and larger snowball that keeps spitting out more money at you. And then once you start to see that dividend lifestyle, well, now you can start using that dividends to live off of. But this is where there's one more option that many people like to consider: REITs. A REIT is a real estate investment trust. In the beginning of this video, I talked about how you can generate cash flow by being a real estate investor. The problem with that is you need a lot of money to start. You need to have all the connections. You got to go through the headache and go through all the work of actually owning and managing your own property. Well, when you invest in a REIT, a real estate investment trust, now you're investing in a company that invests in the real estate. And the reason why some people like investing in REITs for dividends is that REITs are required to follow the 90% rule, which says that the REIT is required to pay out 90% of their taxable profits to their shareholders, people like you, in the form of dividends. And that's why some people get attracted to REITs, because it's kind of like investing in real estate without actually investing in the real estate. I'm going to go over a few examples, but I'm going to just give you my opinion. I'm personally not a huge fan of REITs because I also invest in real estate. I would much rather own the real estate because when I own the real estate, it's something that I can control. I get the tax benefits and it's mine. But that's just me. Other people love REITs, so let me show you what that looks like. For example, VNQ is an ETF created by Vanguard. This invests in office building, hotels, and other real property. At the time of recording this video, has a 3.6% annual dividend. SCHH is a fund created by Schwab. This is an ETF that invests in a broad range of other REITs. So this fund is investing in a broad range of real estate investment companies. This is currently paying out a 3% annual dividend. And then we have XLRE, which is a fund that invests in development companies, management companies, and other broad real estate investment companies as well, which is currently paying out a 3.2% yield. So let's do some math. If you wanted the $50,000 today, you would have to invest $1.38 million into VNQ, $1.67 million into SCHH, and $1.56 million into XLRE. Again, the goal isn't to have the $1 million today, it's to slowly work your way there, because if you know this is your goal, now you can start attacking. You put some money aside to invest every single month. As you get a raise, you invest more money. As you start to get paid the dividend income, you reinvest that money. And the nice thing is, if you invest your money into a good investment, the value of investment goes up and the amount of money you get paid in dividends goes up as well. But I gotta give you one piece of warning. Never make your investment decision based solely off of the dividend yield. See, the mistake a lot of people make is when they get into this idea of dividend investing, I did this too, is you start looking for the highest dividend yields. And you say, okay, let me find the company or the fund that's paying out the highest dividend possible. But sometimes that can be misleading, because the company might show you a very high yield, but the company could also be on the verge of bankruptcy. Because sometimes a company's stock will be falling because it's a really bad company, but they haven't stopped the dividend yet. So if a company is paying out a 20% dividend, it's going to look very good. But if the stock price just fell 80%, you can start to see the problem. Make your investment decision based off of the underlying fundamentals of the company. The goal is to invest in a good company, not just a good dividend, a good company. And then this company should be healthy, should be profitable, and should be growing. If you can invest in a good company, well, now that's where you start to see all the benefits, because that's where you can see the growth and the value of your investment, and you can also see the growth in the value of your dividend. So not only are you seeing your investment go up, but you're also getting paid more money every single year because this company is good and they're growing their profits. That's why you want to go beyond just looking at the dividend yield that a company is paying. And just to be fully transparent, let me tell you the cons of investing in dividends. There's a couple cons. Con number one is when you're investing in a dividend paying company, that means that you're probably not going to see the huge explosion in stock price. Because when a company is paying out their dividends, that means, again, they're taking their extra cash and they're just giving it away. They're not taking the extra cash and investing it for growth. They are giving it away to their shareholders, which means you get some of the money today, but you might not see the huge explosion in the stock price because they're not as aggressively investing in their growth as they potentially could. The other con that you want to think about has to do with taxes. Now, as an attorney who's not your attorney, what I can tell you is that when you get paid a dividend, you generally pay a lower tax rate on the dividend income, but you still have to pay taxes on the dividend income. Even if you take all the dividends that you get and reinvest them, you still have to pay taxes on those dividends, even though they never actually hit your bank account. Those dividends are being automatically reinvested, but you still have to allocate for that income on your tax returns. So something you want to think about and keep in mind. But the nice thing about dividends is they allow you to take advantage of compound interest essentially automatically. You can follow what's called a DRIP, Dividend Reinvestment Plan, which now allows you to invest more money. You can do it every week, every 2 weeks, every month. You keep investing more money. And then every time you buy more of this fund or this dividend paying machine, you take the money that you're making and you just automatically reinvest it. That way the machine keeps getting bigger and keeps printing out more money for you every time you invest more and every time you get paid that dividend. So let's show you now the 5 steps very quickly on how you actually put this into action. Step number 1 is research. What do you want to invest in? Is there a stock that you want to invest in, or do you want to invest in a fund? Know your strategy, figure out what it is that you want to invest in. Then number 2, automate money being invested. Maybe you follow something like 75, 15, 10. Maybe you're more aggressive with your investments. Maybe you're less aggressive depending on where you are, but you need to come up with a system so you're always putting money aside to your investments, and now you just keep, every time you get paid, throwing money into these machines that are paying you with dividends. You keep putting your money into your investments, and you want it to be automated, because if it's not automated, you can forget. You don't want to forget. Number 3, as you get paid with those dividends, you want to reinvest those dividends. DRIP stands for the Dividend Reinvestment Plan. Pretty much every brokerage will allow you for this. That way now when you get paid that dividend, you keep reinvesting that dividend. That way now not only are you working to grow how much dividends you're generating, your dividends are also making you more dividends. Number 4, allocate money for taxes. Because as you generate the dividend income, you got to pay taxes on that income. So remember that. And then number 5 is a decade of sacrifice. This is a slow game. The first few years, it is an incredibly slow game because you see nothing. Year 1, year 2, year 3, it's essentially you see no dividends. But then year 4, you start to see a little bit. Year 5, a little bit more. Year 6, a little bit more. And now you're starting to see the impact of this. By year 7, now you're starting to see the real power of this. By year 8, now you start to have a significant stream of income. By year 9, you're starting to see the potential of what might be coming. And by year 10, you will recognize how far you've come. It is not a get-rich-quick game, but it is a get-rich-actually game if you're willing to stick with it. And that's why I say a decade of sacrifice is what you need, where you're willing to spend less and earn more, because that time is going to go. And if you stick with something like this, if you are interested in cash flow, that's what I'm interested in, that's why I'm making this video, well, after a decade, you can have a completely different financial outlook with a whole new stream of dividend income if you're willing to go through the steps, go through the process, to go through the hard work, to keep investing your money, to generate a whole new piece of income. And with that, I want to hear from you. Is dividends something that you're interested in and want to learn more about? Let me know down in the comments. And how far are you on your journey? Let me know again down in the comments. If you want more research, again, my team at Briefs Media has a free newsletter called Market Briefs. I have that link for you down in the description. And for those of you that want to stay up to date on market shifts, you can look at some of our Brief Pro products where we have education, we have investor research, and a whole lot more, if this is something that you're interested in. Quantum computing is the next generation of technology. You could think of quantum computing kind of like a supercomputer on steroids to the 1000th power. All that means is that quantum computers can solve a lot of math problems very fast. Bitcoin is built on the blockchain. This is a chain of a lot of math problems.